Industry captains on Monday held a pre-budget meeting with Union Finance Minister Nirmala Sitharaman, with the ongoing global slowdown weighing heavy on their minds. They appealed to the Finance Minister to boost capital expenditure, rationalize personal tax rates, and create jobs so that the country has some immunity to deal with the global slowdown, which has now arrived at the shores, as visible from over 16% contraction in export. Their clear focus is on consumption revival. CII President Sanjeev Bajaj said, "The external scenario is likely to continue to be unfavorable for some time. Hence, we must broad-base our domestic economy by creating new sectors of growth and driving employment generation to boost domestic demand, inclusion and growth." Bajaj urged the government to broaden the tax base with the goal to increase the tax per GDP ratio to at least 16% over the medium term from the current level of 11.7%. CII suggested rationalizing personal income tax slabs and rates at the lower end to boost disposable incomes and provide targeted relief from inflation. The PhD Chamber of Commerce and Industry President Saket Dalmia also said that increasing tax benefits for consumption expenditure is necessary to boost economic consumption. He said that tax rebate on purchase of self-occupied house is given 200,000 rupees only since the last many years. Now this needs to be enhanced with the wider scope of consumption expenditure such as the purchase of more than one house, purchase of a car along with other durables. Consumption expenditure rebate must be enhanced to 500,000 rupees per annum. To bring about simplicity, consistency and rationalization of the capital gains tax regime, CII also suggested a framework of long-term capital gains tax or LTCG at 10% with a uniform holding period 12 months for equity-oriented mutual funds and REITs as well as debt-oriented products such as bonds and mutual funds. It also suggested short-term capital gains tax or STCG on the above financial market products at a uniform rate of 15%. On assets other than financial assets like immovable property, the industry body suggested 36-month holding period or LTCG at the rate of 20% with indexation. However, with the current climate of austerity across the world and major economies choosing to raise tax rates, one wonders why India Inc. is rooting for a more rationalized tax structure. The former Secretary General of FICCI and founder at TC Skills, Dilip Chenoy explains.
There has been a steady increase in inflation. And at the same stage, before the Reserve Bank started increasing interest rates, there was actually declining interest rate. So the amount that a person who was saving and getting actually became less and less. The amount of money became less and less in their hand. And now with high inflation, the amount is even further reduced. Also, the tax rates have not been actually changed at the low end for quite some years. And therefore, a request is being made for the government to consider reduction in income tax rates.
While it does look like a positive move, will the demand for lower taxes only help the common man? Business Standard's Suveen Sinha explains how this can ultimately help India Inc. as well.
So why is India Inc. batting for the small guy? Let's break up the demand from India Inc. into two parts to understand that. What is their demand? The demand is to rationalize personal income tax slabs at the lower end and boost disposable income. If we break this into two parts, part one will be rationalizing personal income tax slabs and rates at the lower end, and part two is to boost disposable income and provide relief from inflation. The part that really matters here is the second one, which is to boost disposable income. So disposable income increases consumption, and consumption increases demand, and demand increases production, and more production meeting more demand leads to more sales, which can create more profits. Now, to increase the disposable income, you can either increase salaries and wages, which does not seem to be an easy option in today's circumstances, or second option, you can cut taxes. So the demand for tax cuts is in effect a demand to increase disposable incomes. So who do you think is batting for whom here?
Can the government even afford such tax cuts?
If you look at the last 2 years, the government they're on track on exceeding their tax collection. So you will actually find much more compliance in tax. And second, the amount of money that is saved in the person's, due to the tax reduction, would either be saved, which is also good, or would be spent on consumption. And again, mainly they're going to be spending on items which have GST, right? So the GST collections also will go up. I believe that this is a positive step to consider.
India Inc.'s demand for tax cuts seems like a positive push for boosting consumption. The government clearly faces a tough balancing act between negotiating its own post-pandemic needs with those of the companies as well as the common man.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.